Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Paul Gu, the co-founder and the head of product and data at Upstart. This is our second conversation with Paul, and his first episode is actually still our most listened to episode of all time. So we're excited to bring Paul back. It was a really interesting conversation, delving into some recent innovations Upstart has made around measuring the impact of macroeconomic conditions on loan performance and really separating out individual performance of loans from the macro economy's impact on those in a very quantifiable way, which I thought was a fascinating topic. It's a really interesting area of research. So we kind of dive into how it works, why, how that can be utilized, and what Upstart is working on in the future towards this. It's a really interesting topic, one obviously highly relevant in the current environment. And so I appreciated having a chance to dive deep with it with Paul. I will say there's one correction to make up front, which is that Paul mentions what he called the Upstart Macro Forecast, or UMF, and the correct term is Upstart Macro Factor, still UMF. And without further ado, please enjoy this conversation with Paul Gu. Paul, welcome back to the podcast. Thanks for joining us again.
Oh, I'm happy to be back. It's grown quite a bit since I was last here.
It is, and yours is one of the most popular episodes, the original that we've ever had. So apparently our audience likes technical discussions. We talked about AI and lending in a more technical way last time, so we're going to try and give them a little bit more technical stuff.
Great, let's do it.
Well, the topic of discussion today that I really wanted to dive into is the topic of what we call the Upstart Macro Index, or UMI, because that's been, I know we've talked about it a bunch in earnings, we've talked about it publicly, we've talked about it with our partners, but we haven't disclosed a lot about it or gone in depth. And so I know some people have gotten one-on-one, introductions or explanations, but I want to spend the day kind of diving into it. So maybe the best way to just start is like, what is UMI?
Yeah, UMI stands for Upstart Macro Index. And before I describe what it is, I might take a step back and just describe how we got here and why we started working on this thing that became known as the UMI. So if you take a step back and look at where we were in, call it mid 2021, at that time, very loosely speaking, almost everybody was doing a good job of repaying their loans. Obviously, not everybody. There were always defaults. But repayment rates were extremely high compared to historical norms. And it had looked like at the time, everybody was a genius in lending. You could have lent to pretty much any type of consumer, and probably you were outperforming your expectations in terms of repayment rates and therefore rates of return on debt capital deployed. Then you fast forward another year to mid 2022, and the story had flipped. Instead of every type of borrower outperforming, now you had almost every type of borrower underperforming. And the change from mid 2021 to mid 2022 was dramatic. And you could see that in a variety of metrics, but it wasn't totally clear how you would precisely tease that out and quantify what had happened in the quote unquote macro environment from mid 21 to mid 22. And we started to have conversations with a lot of our lending partners of the forum. Well, what's going on? All I see is that delinquency rates have gone through the roof. I don't know if it's because has Upstart decided that, has Upstart's models gone bad? Has Upstart just sort of opened the floodgates to low quality borrowers? Servicing degraded? What in the world is going on? And when you see a very dramatic change, 2x, 3x, and we're talking large multiple in a short period of time, people naturally get worried and they want to know. And of course, we wanted to know too. And we had a pretty good sense from the indirect metrics that we had, of course, kept our eye on, but it wasn't precise in the way that we would like to have had it. And so we said, well, we really want a precise quantitative way to tease apart what we call the macro and the micro effects of underwriting. And more precisely, what I mean by that is if you think about what an underwriting model does, on the one hand, it has to separate risk, meaning it has to say this particular applicant is more likely to default than this other one, and they're more likely to default by 2 times. But another thing it has to do is it has to figure out the absolute levels of default risk. So that first baseline borrower, what does a nearly risk-free borrower look like? What does a super risky borrower look like? And what is the average population default rate going to look like? And the reason that those are such separate problems is that for that second problem, you really have, in some sense, very limited amounts of historical data to train on in the way that you would like to train an ML model. Whereas for the first problem, the risk separation problem, you have an enormous amount of data that you could look at. Basically, every single default that's ever happened is mostly a story of relative default. It tells you that within a given period of time, how likely was a particular borrower characteristic to default compared to some other borrower characteristic. Whereas to look at the average level of default in, say, a year, well, you only have so many years on record, and you certainly don't have the thousands or millions of data points that you would like to have. I mean, human history barely goes back that far, and certainly we weren't recording our loan repayments, going back to those days. So, that makes it very challenging. And so we sort of have just like a handful of meaningfully different periods, recessions and non-recessions. You can think of it as like maybe like 20 data points in recorded history. And 20 is just not enough for any kind of serious machine learning training problem. And so we separated this sort of micro question and this macro question. And we said, okay, how can we just precisely measure the macro component and know whether a period of time is seeing a increase or decrease, and of how much compared to past periods in its average level of default across the population. So that's what we wanted to know. And about 18 months ago, we started pouring a lot of our research science attention to this problem. And the end result is something that today we call the UMI, the Upstart Macro Index. The Upstart Macro Index, essentially, it aims to tell you if you had constant borrowers, if you were just constantly making loans to the exact same group of people across different periods of time, what would the delta in their delinquency rates be in different days, weeks, months, years, whatever time frame you want to compare. And the way it does this is by making use of what we call a reference model, because of course you can't actually find exactly identical borrowers every single year to make loans to. And no matter how you control it with one variable, two variable, you might say, well, let's just look at borrowers who are 680 to 720 on the FICO scale. And that would be a very simplified way to do this. But of course, there are a million other things to know about these borrowers other than their FICO score. And so the way to do that in a more holistic and continuous way is with what we call a reference model. So you say, what if we underwrote all of these loans with exactly the same model? Because of course, in reality, every loan you have on your books was underwritten with probably a different model at a different period of time. But if you instead underwrote them with exactly the same model and made predictions for every single month that you've subsequently observed, how do the actual delinquency rates and default rates compare to what a constant reference model would have predicted? And what that tells you, the reference model is doing the work of controlling for the consumer. And then what you can observe is, of course, the actual loss rates in real calendar months compared to what the model would have predicted on this sort of abstracted, hypothetically constant kind of calendar time period. And so the deltas in those observations compared to a sort of now controlled expectation of default or delinquency is going to tell you how much more or less risky 2022 was compared to 2021, compared to 2019, compared to 2017. And so that's what we've developed. We call it the Upstart Macro Index. And it does a really good job for us of both explaining how sort of past delinquency patterns have played out and why they've played out that way. And also actually in being able to make forward-looking statements of the form, well, if the macro environment gets 50% worse, then this is what will happen to your loss rates. And being able to make statements of that form, of course, then allows us to make useful statements about how we should be building in buffer and conservatism to the underwriting for any given lending partner, how aggressive or conservative their parameters are set in how much lending they want to do. So really useful both backwards looking and forwards looking.
So I got a number of questions to dive off of some of the things you said, but first I kind of want to be really clear. So when you produce the index, it's a singular number for any given month, as I understand it. How should someone look at the number and say, what does this tell me? If it's a 1.0, a 2.0, a 0.5, like what's the actual index and how do I think about reading it? And then I want to dive into a bunch of things that you said about this.
Yeah. So the index is condensed down to a single number, as you just said, and that single number can be applied to any length of time. So usually we talk about it in 1 month periods because most of our loans have 1 month repayment periods. So it makes a lot of sense to look at it that way. But you could look at them in days, weeks, years, quarters, however you like. But for a period of time, you're going to have a number, and that number is going to range, call it between 0 and 3 generally. Though, of course, there's no theoretical upper limit to how high the UMI could go. But what we've normalized the numbers to mean is that a 1.0 generally is meant to correspond to what we think of as a sort of historically normal time, or at least historically normal time in our recorded history, what you can generally think of as being the sort of 5 years before COVID. And those 5 years, there was relatively sort of a stable macro environment. We did not see large changes. Again, taking that reference model approach, if you're just underwritten all the loans using the same model, you would basically see the same sort of results across the different calendar years. Whereas after that, of course, once you get into the COVID world, you see both large positive and negative shocks to that, which is exactly what this methodology is hoping to tell us about.
Yeah, I imagine that the COVID period, particularly the very serious economic impact, then the rapid input of stimulus and then the rapid withdrawal of stimulus was like changing of macro conditions on steroids, or at least at fast forward speed in terms of a normal cycle, which I think is kind of what was some of the impetus for this, is that kind of rapidity of change, what we usually think of as maybe not a super slow, but not as rapid of a changing environment as we experienced over the last 24 months.
Yeah, totally. I mean, it was almost a perfect couple of years to showcase just the difficulty of the macro prediction problem, which we've always felt was not really a good prediction problem, in the sense that you have so few of these events, as we talked about, and each shock looks really different. And so trying to predict them based on past shocks looks kind of silly. And I mean, April 2020 was probably the most extreme example of this, where April 2020 hits, and of course we've built over the years plenty of what you'd call macro prediction models that look at things like unemployment rates and various sort of macro indicators. That unemployment generally has, in past shocks, been the single biggest driver. But what happened in April 2020? Well, unemployment rates went through the roof, a sort of never before seen rapid rise in unemployment. And yet, what happened to loan repayment? Well, it turns out that within a very short time, loan repayment did not get worse. It became the best period of loan repayment probably ever in all of human history. And it was because, of course, the government responded very forcefully to the increased unemployment pandemic, and did a lot of stimulus in various ways. And people had a lot of extra cash to make their loan payments, and not as many places to spend it because they were locked up at home. And so you got exactly the opposite effect of what sort of historical precedent would have told you. And then if you look to 2022, you get almost the mirror image of that, where you have extremely low unemployment, basically pushing records in terms of how low unemployment gets. And yet you have this rapid rise in delinquency rates. And it's for exactly the same reason. The stimulus ends, people still had jobs, but it turned out that printing money and giving it to people had a bigger impact on whether they would repay their loans than seeing if they were working or not.
So I want to ask about kind of how traditional lenders, I mean, this is certainly the topic of how is the macro economy playing into loan performance. I mean, every time I talk to lenders, they're looking at inflation rates and interest rates and unemployment rates and trying to understand what that's going to mean or is doing to a given portfolio. So how do you think traditional lenders have looked at the kind of problem you're trying to model, or at least the data point of like, what is the macro environment doing to the loss rates in a pool? And what are the weaknesses in the way it's traditionally been done that you were trying to solve for when you thought about building out the UMI methodology?
Yeah, so I think there's a spectrum of approaches, but they share a couple things in common. The first is that because many traditional lenders don't change their underlying models very much, or they have very simple ones that have a very limited number of variables, they can kind of make an assumption, and it doesn't seem as crazy as it does in our world, though we'll get to why it still suffers from some of the same challenges. But it doesn't seem as crazy to make the assumption that, hey, we are underwriting with a constant model, and so the borrowers that we produce across different years should roughly be the same. And if they're roughly the same, then I can understand where the macro is just by looking at the average default rate in my own portfolio. And this is sort of okay. It's sort of okay because if you actually don't change your model in any way, then actually you do have a fairly sort of constant model. But of course, it also assumes that your borrower mix is unchanging across time, that your sort of pricing approaches have not changed across time, and of course that your model actually hasn't changed in any way across time. And of course, we know that even if you just were using, say, the FICO score to underwrite, of course, the FICO score distributions are changing across time, and the inputs to it, are getting changed by, how medical, bankruptcies are handled and sort of different things like this. So there are actually a bunch of these changes happening under the hood, and maybe they're not that extreme, but put together, they're probably each, 10, 20% type effect. And soon you could be in this world where you might be seeing default rates that are 50% higher, and now you have to ascribe that to macro, when in reality, it might just be that your borrower mix changed 20% and your underwriting model changed 20%, and there you are with the 50%. So that's pretty inherently challenging to measure macro in. And then I think on the sort of response side to macro, I think it's also when you don't have sort of a precise factor that's able to separate what your underwriting model is doing and what is happening in the macro, there's always this temptation to say, well, we can fix the problem just by changing the underwriting model. So if we only focus on higher FICO borrowers or higher income borrowers, then we don't have to worry about the effects of a recession or the effects of a macro shock. And I think that is an approach that really can get you into trouble, where you look at a lot of past recessions, something like 2008, and you look at what happened to credit card delinquency rates in 2008 or mortgage delinquency rates in 2008. And what you see is actually that the largest multiple increases to delinquency and default rates were in high FICO buckets. Maybe it's a little counterintuitive, but then if you think about what was happening in 2008, of course, one thing is that the biggest stress were on people who were buying large homes and had big mortgages. And of course, that's going to be a primer consumer. And another thing is that, of course, it matters quite a lot, the kind of shock in the economy and whether that's something that's going to impact more prime people or less prime people. But some of the less prime people actually, in some sense, are like always in a recession. They're kind of living paycheck to paycheck in a way that means their loss rates are normally much higher, but it's also harder for them to get so much higher. Whereas, when you have someone who goes from being comfortably sort of like, putting money in the bank every month to suddenly loses their job, it's sort of a fairly tremendous change in their ability to pay things. And of course, their debt obligations are much larger. There's sort of a less kind of ability to easily make up for it just by going to backup sources of cash. And so there's these different effects that play out, but it's very hard, I think, nearly impossible to solve for macro problems by changing the borrower level characteristics that you underwrite to, because there are no set of characteristics that are inherently recession proof or macro shock proof. And even if there were, frankly, I think we don't realistically have the historical data to identify what those are today.
The other thing that occurred to me as I was reading through the approach to UMI is the sense that, particularly to see things in real time, you not only mean what you've really said is, to do this right, I need a way to hold the borrower base constant, some sort of a constant reference model, the credit model constant. But I also need really an individualized risk prediction, and ideally a month-based risk prediction, because if I want to see what happened in this month, I want to see, did I expect this some months or every given month of seasoning that could be for your loan portfolio exists in the portfolio somewhere. And you want to know, is this loan that went delinquent in month 32, was that unexpected or expected? And so you need really a pretty precise model of risk to be able to see this in something like real time. I mean, not real time, but to see it rapidly and quickly and to be able to adjust. And so it occurred to me that the kind of individual risk prediction and loan level and month level risk predictions in the reference model are really critical to being able to see, not just with granularity, but with speed, what's actually happening in the environment and how it might be changing from what the underlying predictions might have expected.
Yeah, that's totally right. If you only have lifetime default probability predictions, or you only have those for certain buckets of borrowers, and you're not going to be able to do this thing. I mean, you won't be able to control for the borrower mix at all well with a reference model that doesn't consider enough individual characteristics. And if you only have a lifetime prediction, then of course you can't compare what's going on in different periods of time. So you really need a model where you have a lot of confidence that, the month 7 prediction for this particular individual really is a good prediction, at least in relative terms, relative to your predictions in the other months and relative to your predictions for other borrowers in that month. And if you have confidence in that, you can think of as, if there are months on the sort of x-axis and borrowers on the y-axis, you need to feel like both your axes are really doing a lot of work for you, that it's sort of an unbiased estimate. And if that's the case, then you can actually take that point on the matrix, if you will, and compare it to other points on the matrix, and it tells you something meaningful. And of course, if you don't have that, then you can't do that comparison.
Yeah. So I did want to ask, you call this the macro index. You talked about the macro and micro prediction levels of the model. And it's interesting because macro can be a reference to the macro economy, the kind of broader world, but it's also kind of a size metric, macro and micro. And so I kind of want to just ask the question, like, how do you think about the relative importance in any given moment or overall for the micro portion of what you might call the core risk modeling that Upstart's been focused on, and this kind of macro level that's maybe harder to predict, but now somewhat more measurable through UMI? How do those kind of stack up in terms of how important they are to a lender and to a lender's portfolio performance?
So I might first say they're both really important. They're both important in the context of, fixed income of any kind has this property that you can lose a lot more money than you can make. That's the nature of fixed income. And that means, generally anything that can meaningfully increase your default rates is something you're really going to care about. And certainly both the macro and the micro here fall into that bucket. If you get those really wrong, it's going to really affect the return you were expecting. Now, having said that, if you were to just force a competition between the macro and the micro, how much can losses vary based on macro and how much can losses based on micro? I mean, frankly, then it's not even close, because the macro, you can get a period of time that's 3 or 4, maybe in an extreme case, 5 times as bad as another period. In micro, of course, you can get borrowers, not just theoretically, but even identifiably. For example, in our model, you can identify borrowers who are like 80% likely to default, and you can identify borrowers who are 0.8% likely to default. So, you're talking about a 100x spread between the sort of highest and lowest risk in micro, and you're talking about a 5-to-1 spread in the highest and lowest risk in macro. And so, of course, it's so much more important to get the micro right than the macro right. There are so many more ways that, even in the best of times, if you try to go to market and underwrite with an extremely poor performing model, just everything will go wrong. And not only because your model will be wrong, you'll face adverse selection because other lenders will pick off at lower APRs the better borrowers. And just so many things can go wrong in micro. Whereas in macro, things can also go wrong, such as, when you go from a really, really unreasonably good period like 2021 to really a sort of sharply bad period like 2022. That's going to significantly and negatively impact lender returns, but it's still going to be on, if we're talking about annualized return impact, I mean, depending on what your risk mix is, I mean, you're still talking, you can count it on your 2 hands, like the number of percentage points of impact that's going to have. Whereas if you get the micro wrong, I mean, there's really no limit to how much money you can lose doing this. And of course, on the flip side, when things are going well, micro is what enables you and has enabled the lenders that use our platform over the years to be able to make dramatically more income running a lending business, because micro is what enables you to confidently expand your approval box while holding your risk levels constant. And so if you can approve 50% or 100% or 200% as many borrowers as you previously could, but you get the same risk levels, then of course, suddenly now you're able to meaningfully change the amount of lending income being generated.
Interesting. Well, I want to dive into a different topic. You made this comment about like if you can model out if the macro got 50% worse, or I'd love to say 50% better. Sometimes I worry that we talk about the macro, we only talk about bad macro, talk about macro getting worse and protecting, and not the fact that, particularly from where we sit as we're recording this, there's probably more upside for the macro getting better than substantially worse over the next at least 12 or 18 months. But the interesting thing is you haven't talked really about what I would consider traditional macro variables, right? Like most people, when they talk about how's the macro doing, you have a UMI and you'll talk about where it's at. But most people look at inflation, unemployment, interest rates, maybe savings rates, things of this nature that are very clearly tied to what we think of as a macro economy, GDP or something like that. What is there a relationship? Are those part of the UMI model? Talk to me a little bit about how like traditional views of what is happening in the macro relate to the Upstart Macro Index, or how you think about the impact of macro in the lending portfolio.
Yeah, they're super correlated. In short, the Upstart measured UMI, we like it because it has the nice property that it's directly applicable to the math you want to do on lending. And because it's really specifically designed to tell you this period is a period in which you can expect twice as many delinquencies on the same borrower pool as that period. It lets you do math in a very precise and direct way. But of course, it would be really concerning if this index that's meant to measure the macro is totally unrelated to the sort of traditional macroeconomic variables, which of course, though each one maybe only tells part of the story, they are collectively, a pretty good description of the things that we care about in the economy. And so we have that's been an important part of developing the UMI, is actually building a sister model that tells us what we haven't found a nice sort of externally marketable name for it yet. But if you think about, there's sort of UMI as measured in the sort of collective repayment rates of of all Upstart platform originated loans, where we have access to the data. But then there's UMI as you would predict based on what you're seeing from the sort of official macroeconomic data, the unemployment rate, the inflation rate, the personal savings rate, and what you want to see that these two measures, the sort of internally measured UMI and the externally inferred UMI, are largely moving together, highly correlated, and kind of moving together, and that's exactly what we see. We've been able to see that, and actually, you can, the maybe short and snappy version of this is if you just want what single variable released by the Fed can tell you roughly where the UMI is going, and the answer would be the personal savings rate. That, of course, is a bit cheating because the personal savings rate itself is a bit of an amalgamation of a bunch of variables. It's looking at broadly looking at personal income and personal expenditures. But of course, what makes up personal income? People have to work, so there's employment rates baked into that. There's wage growth baked into that, and then of course on the personal expenditure side, there's sort of your real rate of spending, and then there's the inflation rate. And so you kind of got this one variable that the Fed publishes, at the end of every month, and it tells you roughly the things that really matter: unemployment, inflation, spending, and wage growth. And the net of that sort of is like how much money people have left over, which is a really good proxy for how much money people are going to have available to service their debt. If you just look at that one variable, that's probably like mostly correlated with how we've measured UMI over the past years.
It does seem like I won't say a cheating variable, but it is an amalgamation that takes into account a number of the things that people traditionally think of as pretty impactful to at least particularly unsecured credit, where there's, it's kind of I won't say the riskiest, but the bottom of the payment stack in many ways, where the first thing to take a hit when times get tough. So one thing we haven't talked about today at all, and I'm sure our lending partnership seems to be very upset with me that it took me this long to ask this question, but I think there's obviously, when UMI goes up, if the macro gets riskier, there's this question of, is that a direct indication of loans under or overperforming? And how does the sense of the macro play into how you actually work with a lending partner to assign a level of risk to a borrower at time of underwriting and understand the returns produced by that portfolio. So I think the thing that I hear a lot is like, does a UMI above 1, meaning all my loans are underperforming because the macro is high and therefore I'm losing money and that's a bad thing and I should stop lending or whatever. So talk to me about how you leverage this in the context of partnerships with originators to kind of calibrate to what's going on and help them understand the level of risk in the environment that's going into their originations.
Yeah. So in short, no, it does not. There's no direct way to say UMI is a certain number, therefore my loans are either over or underperforming. To know that, you need to know one more thing, which is essentially what UMI were you assuming when you made the loans in question. And that particular thing we call the UMF, the macro forecast. And if you, very roughly speaking, if you just, for any batch of loans, if you take their UMF and you then look forward and say, okay, I made this batch of loans in January of 2022, and at the time we had a UMF of 1.0, and now the UMI is 1.5, then that sort of implies that you're going to have actual losses that are 50% higher than you forecast. And in that case, sort of the example you gave is valid. Now, fast forward to more recent times, and many of our lenders actually have a much higher UMF. Imagine your UMF is 2.0, but the UMI that's been observed since is only 1.8. Well, then actually, even though 1.8 is a really high number by historical standards, it's actually 10% lower than the UMF that you assumed. And so that means that your loans were priced as if you were operating in a 2.0 type world, but actually you've been seeing a 1.8 type world. And now you're going to see defaults and delinquencies that are running on average 10% lower than you were expecting, which of course means more sort of net interest, more excess returns, and so returns will be higher than expected. And of course, it matters how this plays out over the whole sort of term of the loan, but just roughly as an approximation, if you think about a single point in time, this kind of tells you this ratio between the UMI and UMF tells you how things are going to be. And so if you underwrite with a fairly high UMF, then of course there's more room for UMI to positively surprise against that. On the other hand, if you underwrite with a high UMF, you're going to be passing up a lot of borrowers and pricing a lot of other ones out of converting, just because you're assuming that the world is in a really bad place and you want to lend to people who who are going to be going through a really hard time. And of course, if they aren't, or if other lenders are not seeing it that way, then those borrowers are going to go elsewhere.
How can you help a lender think about, what a UMI or UMF of 2 or 1.8 or 1.5? Like, I feel like that's not something that, at least as of yet, it'd be great for you if that became something about which people had an intuition and a natural understanding. It was like a number they were used to kind of thinking about where it may trend and where it may fall. But how do you think about like what causes a UMI or UMF to get to a certain level? Can you, I think that scenario planning of, if you think about just the Dodd-Frank stress test kind of thing, if unemployment goes here and something goes here, like how bad does that get? What will happen to my portfolio? How do you think about connecting the dots between those, that the concept of, what might happen and what that'll mean to, where these loans could be performing?
Yeah, I think there are two good ways to build intuition around these UMI index values. The first is to go back to that personal savings rate, which is largely correlated, not perfect, but pretty good. And again, includes the unemployment and the inflation, all the pieces. And what you can basically see is that you can think of it as a historically average level of the personal savings rate. Let's just be round numbers, call it on the order of 10%, roughly corresponds to a sort of normal UMI condition of around 1.0. And then, what happens, of course, if the personal savings rate goes up, if the personal savings rate goes up to something like 20%, which, basically never happens except in 21 when, people were given
money going out the door.
Yeah, exactly. But when you get something like that, then you see UMI basically get cut in half, down to about 0.5. And again, I'm just speaking in round numbers here. And then on the other hand, you can see UMI values go from 1.0 to 2.0 if you basically, roughly speaking, cut your personal savings rate in half, which is on the order of what we've seen over the past 18 months or so. And then the other sort of way to build intuition is just to look at different periods of time. So again, UMI 1.0 roughly corresponds to the 5 years before the COVID period. In the sort of happy days of free flowing stimulus money, you've got UMIs that go down to nearly 0.5, and then stimulus running out, producing that large shock, takes your UMI over 1.5. And then if you were to sort of look at historical values of personal savings and UMI, sort of ask the question, well, how bad can it get? At least how bad have we seen it get historically? Probably the answer is something like, in the worst times ever, that again, in recent recorded history, we have all the relevant economic data, maybe something like the worst month of the Great Recession, we think UMI would have been in the high twos.
Interesting. So I get two more things I want to hit on. And then I think we've kind of at least gotten a good intro for people into this concept. One is, we didn't really talk about this, but UMI, as you've built it today, is really based explicitly on unsecured installment loans, particularly the kind that Upstart partners with banks and credit unions to originate. Are there intentions to build something like UMI for other asset classes? Is it applicable to other assets? Like, how do you think about the usefulness of it as a construct, or the limitations of it as a construct, given that it's really a measurement specifically on a particular category of consumer credit?
Great question. So we don't see UMI as something that you just develop the methodology once and it's done. It'd be nice if it was like that, but really it's a very sort of rich surface to explore, because there's not only the question you mentioned, which is the question of UMI for different products, but there's actually UMI for different types of consumers. And while maybe on average they will all move together, they don't, of course, exactly all move together. Their slopes are a little bit different. Their sensitivities are a little different. And so what we really are, you can think of the progression of UMI methodologies as going from, first, you sort of assume there is just one UMI, quote unquote, working off one reference model. Then you have one UMI that's produced actually by an amalgamation of reference models, and that sort of gets more and more continuous as you go from 1 to 2 to n, and you really get to a methodology that's sort of much more continuous with respect to your reference model. And then you have a sort of second dimension of UMI methodology improvement, which is really about going from assuming sort of quote unquote the average borrower to really making it something that where the UMI is interacting with the borrower characteristics, not unlike how we see all the sort of the other work we do in sort of prediction realm. Is there's just interaction effects going on between almost any given characteristics of a borrower, and of course those also interact with macro, and so those should be considered. And then the last sort of dimension is the type of loan that it is, and that's true of its size, of its duration, of its type. And so that could be it being an auto loan, a personal loan, a 3-year loan, a 1-year loan, or any sort of combination of these. And so there's a lot of sort of continuing research into UMI that we're doing. Now, having said all that, the good news is that we think even this first version of UMI, as a first approximation, if you just want to answer the question of under what conditions will my loans over and underperform, and by roughly how much, you're going to get a very good approximation just from UMI V1 that is true. It's built on unsecured personal loans, but we look at it in the context of our other products, like our auto refi products. And again, it's not quite as precise, but it does give you a really close first order approximation of your level of over and underperformance. Again, looking at those UMI and UMF ratios of the changes across time. So it does a good job explaining, and that it gives us more confidence in the methodology, because it tells us that there's something very general happening, in addition to the sort of many smaller but more specific things going on within each product, within each type of borrower, and so on and so forth.
Interesting. I guess my last question for you is, it sounds like this is early days in the development of UMI, like a very solid foundation, but compared to the work you've put into understanding micro risk is still pretty immature in comparison and has a lot of room for improvement. And you also mentioned if people want to get an intuition, they should look at the numbers. So if people are interested in looking at the numbers or following along as the methodology and kind of the insights coming out of the work into macro and the UMI evolve, is there a place they can go to see those? Are they published somewhere? Is there a place they can follow along what's happening? Like where can people go to learn more and keep up to date with, what's happening to the UMI and what's happening to the work and to looking into this macro concept?
Upstart.com/UMI, just out. And we're really excited about it. And it's going to get better and better, but it's going to have the core data there, and there's going to be more ways to engage with and play with it and really understand the numbers. So yeah, go there, check it out, see how those values have changed across time, what they were in different periods of time. And I think that will really build a good level of intuition for this. And certainly it's our hope that this would become a tool of general interest beyond those who are either making loans through our platform or even making loans in general. But really, we think it's a really good and useful tool to just understand what's going on in the world.
Upstart.com/UMI is not a very original URL, very straightforward and easy to remember. So I guess that's probably better than original. And I look forward to seeing that. I'm actually really excited that we're going to be publishing the data set. So kind of the historical data set. I think there's a lot of rich surface area for innovation on top of it. So I'll be excited to see. And if any of the listeners have questions or feedback on what's useful or what you'd like to learn more about the concept, please do write to us or write to just me at jeff@upstart.com, because I think it's actually a really interesting space and would love to have real input from all of you in terms of where we take the research and what we learn next. All right, Paul, thanks for taking the time to join us. This was, I think, a great first dive, and I appreciate your coming back for your second time on the podcast.
Awesome. Great. Thanks for having me.